Tom Lee just outlined why he is so bullish on this market. If you're an investor, get ready.
So let's dive into this. Uh, I'd say that we still think November is going to be an up month. I mean, with a lot of confidence. And the first reason for that is that stocks are up 6 months in a row, and it's almost going to strengthen the case for November to be positive. But we know it's going to be choppy. We think it's a choppy first 2 weeks, but then we ultimately end up, over 200 points on the S&P. That would take us past 7,000. And these are the 6 years that I think are precedent markets. These are the times where the markets were up May through October. And you can see that the November to December, which is far on the far right, has been positive, except in 1936 when the markets basically were flat. But, I think we're in a very different place. That was post depression period. We're really in the middle of an upcycle. And, I still think we're going to be at least 7,000 by year end, maybe 7,300. And if you think what's late cycle, just keep in mind that ISM is still below 50, 33 months now. We've never been top of the market when the ISM is below 50. And keep in mind, housing is still undersupplied. We have built only 13.6 million homes in the past 10 years versus 15 million household formations. That's a shortage. That's the opposite of the GFC, when you had basically 7.5 million excess homes. And for those who think valuations are extended, keep in mind NVIDIA is trading at only 29 times forward earnings. Costco's at 42.6 and Walmart's 35 times. It's still cheaper to buy NVIDIA than to buy a GDP grower. And in 1998, Cisco was already at 56 times forward earnings before getting to 210 times. So I think we're far from a bubble today. Margins are expanding, and I think it's very telling because earlier this year, you remember the consensus from the Fed was that someone has to pay for these tariffs. So inflation would go up and margins would get squeezed. But in the third quarter of this year, which is in the full force of tariffs, companies taking 67% of that hit, earnings grew faster than revenues. 7 out of 11 sectors had margins expanding. And there's a fund manager chase that's going to happen into year end. So everyone will say, you're going to hear someone tell you, everyone's bullish, Tom. That's not true, because if they were bullish, their performance would be outperforming the S&P this year. And as you can see, 22% of active funds are trailing their benchmark this year. So it's been a bad year for fund managers.
Tom Lee's ISM argument does reveal something critical about how we measure economic health versus market cycles. The ISM Manufacturing Index has stayed below 50 for extended periods without immediate recessions, though historically recessions do occur when the index remains in contraction territory for prolonged stretches. Dating back to the 1940s, readings below 43.5 on the ISM Manufacturing Index have predicted recessions with nearly perfect accuracy over 70 years. But here's what Tom is really saying. The manufacturing sector can contract for months without triggering a recession because manufacturing now represents just 11% of GDP. The economy has fundamentally changed. We're now a service economy. 33 months of sub-50 readings, Tom Lee mentions, is historically significant, but the economy hasn't collapsed because the contraction has been shallow. The depth matters as much as the duration. When the index plunges below 43, that's when real trouble starts. Think of it like a low-grade fever versus a high one. You can function with a slight temperature for weeks, but when it spikes to 103, you're in the emergency room. The manufacturing sector has been running that low fever. Companies are cautious, but not panicking. They're trimming inventory, but not shutting down plants. The services sector is carrying the load. Tech companies, healthcare providers, financial services, they're still expanding. That's why you can have manufacturing contraction alongside job growth and consumer spending. The economy is splitting into two different realities. What makes this so especially interesting is that purchasing managers are forward-looking indicators. They're placing orders based on what they expect demand to look like in 3 to 6 months. Their caution reflects uncertainty more than actual weakness. They're seeing customers hesitate, they're watching geopolitical tensions, they're factoring in election uncertainty, but none of that means the orders disappear, they're just getting delayed. And there's an argument to suggest this creates a coiled spring effect. When confidence returns, those delayed orders rush back into the system. Manufacturing then snaps back faster than people expect. And this is a pattern we've seen play out several times in the past. A few months of contraction followed by a bounce. But there's another structural advantage Tom mentions that gets overlooked in recession debates. The housing shortage argument shows why this cycle is fundamentally different from 2008. Current estimates place the housing shortage between 1.5 and 5.5 million units. Recent data also showed new construction finally exceeded household formation in 2024 for the first time since 2016, yet America still faces a gap of nearly 4 million homes. Tom's comparison to the financial crisis is a key insight here. Back then, we had 7 million excess homes, builders had flooded the market, banks had given mortgages to anyone with a pulse, the correction was inevitable and sadly brutal. Today, we're short of millions of homes, builders underbuilt for over a decade after the crash. Young people are living with parents or roommates, not by choice, but because they can't find affordable housing. That's pent-up demand sitting on the sidelines. This creates a flaw under the economy. Even if we hit a mild recession, housing won't collapse. You can't have a housing crash when you don't have enough houses. Prices might flatten or dip slightly, but we're not seeing foreclosures and fire sales. The demographics support this. Millennials are hitting peak earnings and family formation years. They want houses. Gen Z is right behind them. Immigration is adding to household formation. The demand pipeline extends years into the future. Construction companies know this. They're building, but they're being selective. And they're still burnt and remembering from 2008, so no risky financing. This more disciplined approach keeps the market stable even when rates jump or the economy wobbles. But here's another angle people miss. The shortage isn't just about raw numbers, it's about the right kind of housing in the right places. We need affordable starter homes near job centers. Instead, we're getting more luxury apartments in secondary markets. And this mismatch means the effective shortage is even larger than the headline numbers suggest, which is also leading to an interesting dynamic on consumer balance sheets. Home equity keeps growing even as the economy slows. Therefore, home owners feel wealthier, they keep spending, and that wealth effect supports retail, services, and the broader economy. It's a virtuous cycle that didn't exist coming out of 2008 when homeowners were underwater and paralyzed. One of our clients started with zero audience. Now they're doing $100,000 months thanks to YouTube. And they're not alone. We've helped 3 businesses hit that level just by growing them a YouTube channel. Want to see how this could work for your business? Book a call with me below.